In this video, we're going to break down the four major market indexes: the Dow Jones, the S&P 500, the Nasdaq, and the Russell 2000. I'll give you a breakdown of each and then explain why people tend to choose one over the other. Each of these indexes are simply an ETF. If you haven't watched my video about ETFs yet, check that out first before watching this. The main difference between these four indexes is how they're diversified. Remember, more diversification equals more stability at the expense of slower growth, whereas less diversification equals more volatility with potential for higher growth. The Dow Jones Industrial Average is a price-weighted index that tracks 30 blue-chip companies. Blue chip is investor slang for a highly reliable and valuable company. The Dow is the only major index that's weighted based on share price. This gives it an interesting collection of stocks spanning across several sectors. However, compared to the other indexes, it has the lowest diversification, so it can be volatile. That being said, these companies are the dominant players in their field, so it does tend to perform well overall. The S&P 500 tracks the 500 largest companies based on market capitalization. These companies span across all sectors and industries. However, since this weighting is based on the size of the companies, it ends up being heavily weighted towards tech, healthcare, and the financial sectors. Its diversification gives it a solid risk-to-reward ratio, which is why it's arguably one of the most popular investments for passive investors. The Nasdaq is actually a separate stock exchange that is a direct competitor to the New York Stock Exchange. However, it's also an ETF that tracks the 100 largest non-financial companies listed on the Nasdaq exchange. The Nasdaq on average has the highest overall ROI out of all the major indexes, but it's also the most volatile. Because of this, it tends to be stigmatized as a risky investment by low-risk seeking passive investors. The Russell 2000 is a market cap weighted ETF that tracks the top 2,000 companies. Unlike the other ETFs, the Russell is generally made up of smaller companies. The main benefit of the Russell is that it's extremely well diversified. However, this means that it experiences relatively slower growth compared to the other major indexes. But what it lacks up in gains, it makes up for in stability. While all of these indexes have their benefits, I personally wasn't satisfied with any of them, which is why I created my sector investor strategy. It's a modified version of the S&P 500, except it cuts out the underperforming and high volatility sectors, while keeping the top-performing growth and stability sectors. The result is diversification between 290 different stocks, which places it squarely between the S&P 500 and the Nasdaq for diversification. The main benefit of this is that we're able to invest in each sector individually. The problem with all the other major indexes is that your recurring deposit is sprinkled on top of whatever is pushing up the entire value. But since we can put more money into whichever sector is a bargain price, we can actually benefit from downturns. Not only does this naturally rebalance our portfolio, it increases our growth during upswings.